Welcome to the Messy City Podcast, where we talk with the people who design, plan, build, develop, or even just think about how to create beautiful, successful, and humane cities and towns. Let's learn from each other and create places we truly care about. Hi, everybody. Kevin Klinkenberg here. Hey, the audio was a little wonky on this episode. I think we've adjusted it as good as we can on the back end. I just want to encourage everybody to stick through it and listen to it. It's a hell of an episode. Ward is a great interview, and there's just an amazing amount of great content in here. So crank up the volume and enjoy listening to my friend Ward Davis. Welcome back to the Messy City Podcast. This is Kevin Klinkenberg. Got my man Ward Davis here with me today from Arkansas. Ward, I always forget which. Are you in Fayetteville?
I'm in Fayetteville.
Okay,
Yeah.
all right. I know you're all
Northwest
over
Arkansas.
Northwest Arkansas, so I
Yeah,
never know.
I mean Northwest Arkansas is all one city, but it feels like four small downtowns.
Yeah,
and then a couple of other smaller towns around them.
Yeah, and so you live and have your office in Fayetteville?
Live and have my office in Fayetteville.
Okay. Well, let's do a quick bio here on who Ward Davis is before we get into some fun talk about development and small development. So for anybody not familiar with you, what you can give the short or the medium version, whatever you want to give of your background.
The short version is I've got a couple of economics degrees and then an MBA that I used to get into investment banking and corporate finance. And so my background is in investing. And then I got to real estate development through a couple of friends. I was doing real estate deals on the side when I was working in investment banking, and then met my partner, the late great Morgan Hooker, who was a developer, relatively small developer in Northwest Arkansas. And he and I teamed up initially with another guy, and then added a partner, Dirk Van Veen, and we started working on town center project in 2005 with DPZ and Mike Watkins, and then the rest is kind of history. Been in development ever since then.
Mm-hmm.
You know, including the Great Recession, which was formative as well. So that's a 2-second overview. Everything we do. So my company is High Street Real Estate and Development. We're focused in Northwest Arkansas exclusively. We work only on town center and downtown projects. We have about a half completed TND called Johnson Square. We've done a decent amount of downtown stuff, particularly in downtown Rogers, Arkansas. Got a little bit in downtown Springdale, Arkansas. And then we've got another TND that's in its first phase that we're co-developing with a group, specialized real estate group that's in Fayetteville. We're doing a large TND in Fayetteville. So that's kind of what we focus on.
So what brought you into why do those kind of projects? With your investment background, you could have done a lot of different kinds of development projects. Why these?
Yeah. So, I mean, I think if I was probably going to profit maximize, I would have gotten really good at something very narrow, like apartments or mini storage or industrial or something like that you can really get a method down to reproduce easily, but it's not very much thinking involved, and that's the fun part. And I don't think I would have a good time waking up on Monday morning, whereas right now what I do is a lot of fun. Takes a little more effort, can get great financial returns. They're a little longer in coming, and you got to be a little more clever, but that's part of the fun for me.
Yeah. How did you first get introduced to that world of new urbanism and get hooked up with DPZ and all of them?
Yeah. So Morgan, my partner who passed away in 2022, he had met, I guess he had started talking to Mike Watkins and just reached out, cold call DPZ when he was working on some stuff down in Florida. And about the time that I kind of joined him, and he, when I started talking to kind of the DPZ folks, I started and just noticed my entire life I was always attracted to and would pay more to live in downtowns wherever I was. I wanted to be in the middle of the action. I liked traditional architecture. I liked communities that function, as communities. Hadn't put all those pieces together. I was kind of frustrated that it was always a lot more expensive to live where I wanted to live, but anywhere else just had no appeal to me whatsoever. So um, the conversations just kind of synced up what were my natural biases for what I enjoyed with, kind of the emerging new urban philosophies on how we could develop going forward. And um, very quickly I jumped on it and kind of saw some opportunities that were for creating value longer term, which was something I was interested in from an investment standpoint. Um, and uh, and also building stuff that I enjoyed living in. I felt like most of what I was seeing developed was not something I wanted to live in, and it really didn't sound like a lot of fun to me to build something that I, would never want to live in for myself or want my kids to live in.
Yeah.
So that's really kind of how I got rolling with it. Kind of simplistic answer, but you just enjoyed it.
So how did you then kind of get working on like the town center side of things? Because in that world, there's it seems like a lot of people start just by building houses especially when they're
Yeah,
doing T&Ds, building a lot of little houses.
yeah, we dove right into the kind of the town center side of it. We were working on a project in Fayetteville that went through a bear of a regulatory process called Ruskin Heights that we lost during the Great Recession, and it was not a big. It wouldn't. It's not a big T and D. It wouldn't have been a big T and D, 20 or 25 acres, something like that,
Mm-hmm.
which is too small to do for a town center project. But we didn't know that at the time. But the um, um, kind of the way we started that was with conversations with DPZ. Plus, Victor Dover and Dover Cole had just done a downtown or just done a overall master plan for the city of Fayetteville called City Plan 2025, which is interesting because here we are, and for a better way to grow the city. So we were kind of encouraged that the city was wanting something like this. At least that was our perspective. Turns out that's not what the city wanted. The city wanted to do a master plan that made everybody feel good, and then when push came to shove, they were not nearly as committed to that ideal as I had allowed myself to think. So anyway.
Yeah, I mean, what a crazy idea! Like the plan didn't match the actual regulatory process on the back end of it.
Oh yeah, I was so naive back then. It was adorable.
So tell me, how do you describe a town center project? What if you were to talk about that to other people? What do you have in mind?
I have in mind that a town center project kind of has it's a single development that has um, two different primary components. One is it has a mix of uses, so you have you know restaurants and office and you know jobs and places to hang out, all in the same neighborhood as residential. And the other component that's essential is you have to have a mix of unit types. So if it's all single family homes and just a little commercial building, I don't think it really quite fits as a town center project. There are some that kind of challenge that ion and something like that, but I feel like that's at the very fringe of what might be considered a town center project. But mix of unit types, multifamily and houses of various sizes, so for the most successful neighborhood. So those two components kind of drive what I think of as a town center project. I think ideally, I think town center projects, if at their best, could be, and you haven't seen this much yet, but I would like to see this more often, especially if they're well located. But they could be a central node for cities to grow with more than one with one core. I was actually after Leon Creer passed away recently. I've been flipping through his book every morning for inspiration. His book of these pretty
Mm.
little drawings.
Oh
Here's
yeah,
my
yeah,
Leon Creer
sure.
book with my note for whatever page I happen to be on. and he's got a great sketch. This one, especially recently, has hit me because there's been a real push, particularly in Fayetteville, where I live, to push a lot of density downtown, and then let's leave the single family neighborhoods intact and have 85% of the city be zoned single family. And Creer would argue that a much more functional city is one that has many nodes, and then kind of the lower density stuff is between those nodes, as opposed to just having one downtown and everything
Right.
else. And I think that's ideally, um, what I would see as an ideal growth pattern going forward. It's a little more European, but we could do an American version of that, and it would be, I think, incredibly well received.
Yeah.
Because I'm particularly right now, with other work I'm doing that I'm sure we'll touch on in a minute, particularly aware that great cities, great towns in the U.S. That have experienced a lot of growth over the last 10 or 15 years have really diluted themselves. I'm talking about like Austin, Texas, or Denver, or Nashville, by having their downtowns are cool and they densified, but man, there just aren't very many great nodes outside of
Mm.
that. The growth outside of that has been very suburban, and as a result, those places aren't as cool as they used to be.
Yeah.
You know,
Yeah.
and that's what people are trying to do it better, but nobody's pulled it off really well.
Yeah. Yeah. It seems like, a lot of those models, they have like both ends, like extreme ends of the spectrum.
Yeah,
Where it's sort of like you get the 20 and 30-story apartment towers in the core,
yeah, that's
and
right.
then everything else on the edge is just nothing but single
Oh yeah.
family. Uh,
I just got back from Denver, a trip to Denver. I hadn't been there in probably 4 or 5 years. In the Rhino area, which I always really thought was cool and funky and had a great vibe, the apartment developers have completely, I don't know how the technical term would be, fucked it up, but they have definitely made it worse. I
mhm.
mean, and it needed density, it needed bodies, and it's very extractive what was put in there, and nothing of kind of the scale of everything is gargantuan, and not and, and also insular and also bad. It's just really really kind of depressingly bad
Yeah. Yeah.
stuff there. But that would have been a great, if we could lick growing with nodes that have, um, frankly, if we could have a density, a kind of a three-story walk-up level in a lot of places, you could really have house a lot of people in relatively condensed areas and really have it feel good. We've done that in the past,
Yeah.
but it's almost like an area like that. Kind of once it breaks over, then it gets really um, exceptionally large and heavy, dense, and each of the buildings has got their own branding that's all
Yeah.
cheesy as all get out, and then bad empty commercial spaces on the ground floor because that's what the city made them do,
Yeah.
which they shouldn't have. But anyhow, so
So
I can pontificate on what I don't like about what we developed for a lot, but I'm gonna
yeah.
spend more time on what I do like.
Yeah. So let's talk a little bit more. So the projects you do, are you pretty much keeping ownership of everything as you do it, or how do you work
Yeah,
through
we
that?
do it to own the commercial, in the apartments. I mean, we develop the way I describe our business model on town center projects, and I spend a lot of time thinking about how to make money with these projects. In the past, town center projects have been great at making money for everybody but the developer, in particular, the first home builders or the apartment developer that comes in and kind of dilutes things, or it's been very productive for all of those folks. So. We learned really quickly that they appreciate a lot. They because there's not enough of them built, and so if you hold on to the more you can hold on to, the more money you'd make. So our core business model, and this is completely simplistic, but where we spend our time is food and beverage / retail, single family homes, multifamily, and office. And where we make our money, you can flip it.
Hmm.
So if I can nail the food and beverage, especially you know um, uh, local best of breed operators, then selling houses is easy, renting apartments is easy, and leasing office space is easy. So
Hmm.
an office space in Northwest Arkansas is still very robust. The rest of the world, it's kind of tamped down, but Northwest Arkansas is we haven't even seen a blip on the screen
Interesting.
on Office.
Yeah.
So we have decent amount of Office. Another thing about TNDs in the past and where they've been handled poorly is a town center project with even just the most modest amount of kind of what I consider food and beverage amenity, because the food and beverage for us is like our Neiman Marcus. That's our anchor.
Mm-hmm.
Just a modest amount can attract single family home buyers pretty far abroad in a market. Which means that TNDs are unique in that they can front run a market. They can front run a growth pattern. But how they are best applied and most financially productive is not if you slap one on grandma's farm that was 30 miles outside of town. It just happens to be a really pretty piece of land. And you can get home buyers out there, but you can't get renters and you can't get office and you can't get really good operators for commercial space. But so if you buy the thesis that the best thing to do in a neighborhood that appreciates dramatically is to own real estate, and to own real estate you want it to be cash flowing, then you're better off if you have a piece of land that's a little better located. Now it's still unique among any type of real estate, and that you can front run a growth pattern for a market. But if you can find a place where the land's not so expensive that you can make a play for growth in the area and build a town center project, really things can come to you really, really well. Our Johnson Square project in Northwest Arkansas is a great example of that. It's tucked along it's about a half mile off the interstate. That's kind of the spine in Northwest Arkansas between Fayetteville and Springdale, the next town north of us. And at the time I started the project, it was considered in the middle of nowhere, in the middle of a field, and really kind of is, but I knew it was right off the interstate. I knew the growth was going to, in Northwest Arkansas, it's so extreme that the gaps were going to fill in along that interstate corridor. And that's really what's happened. But I still have people think that it's I couldn't believe y'all did that out there and it's working so well. And in the world of town center projects, this is an easy one. There's a lot of people that have done projects that are much farther out in the middle of nowhere than this.
Yeah. Yeah, I think it's interesting for anybody who is listening and is not familiar that Northwest Arkansas has actually been one of the fastest growing regions of the country now for quite a few years.
That's right. I've got a remarkable pair of graphs that I show on a lot of stuff that show kind of normalized to 2000 population growth in Northwest Arkansas, and then per capita income growth in Northwest Arkansas. And both of those have outstripped the U.S. for the last 25 years pretty handily. The one that I dove into recently a lot is the per capita income, because we were about $5,000 per person lower income in Northwest Arkansas in 2000. And back at that point, that was about 20% less income. And now we're about $10,000 per person higher per capita income than the rest of the country, which is 16 or 17% higher. So we massive delta, and with that comes a lot of growth. A lot of people want to be in an area, so we're in a unique spot where we're growing really, really rapidly, and as a result, we are really trying to figure out how to grow in a way that's more responsible than other places that have grown. We also just happen to have a lot of new urbanists. I think Morgan and I were probably, I say this all the time like it's true, and I don't know if it is or not, but I think we were the first people from the state of Arkansas to go to the Congress of the New Urbanism. At CNU this year in Providence, we had 74 people that I verified, and maybe one or two that have slipped through the cracks. So we're very well represented in that world. So we've got a combination of fantastic growth that with strong incomes, and a lot of new urbanists. So if we can figure out how to grow well, we can really do something remarkable. If we leave it to serendipity, we know it'll happen.
Yeah.
It'll continue to grow poorly, and that's the most likely outcome. I'm fighting like hell for that not to be the case, but it's clearly the most likely outcome.
Yeah.
There's inertia is a bitch, for this kind of stuff.
No doubt.
By the way, if you don't mind for a 2-second aside on that front, I've kind of come full circle. I used to think it was the NIMBYs that were the problem, the single family homeowners were the problem for perpetrating inertia. And I've come full circle on that. I'm almost positive that I'm right about this, and I've never seen a study on it, but I'm feeling my way from just experience, and that is commercial interests drive the inertia. The concentrate. We have taught businesses how to concentrate on shitty corridors,
Yeah.
with massive car trip counts for their businesses. We have taught the business world how to respond to that environment very well,
Yeah.
very effectively. And if we change the rules on them, there will be huge winners and huge losers, and losers fight like hell to protect.
Yeah.
So I view commercial interests, which aren't malicious and frankly less malicious than NIMBYs, as being a greater impediment to success
Yeah.
than I view the single family owners.
Yeah, I mean, I think about that. I think the inertia of that system, you're totally right about. It kind of reminds me of was listening to a podcast not long ago where they were these folks were talking about the Starbucks as a company, just as a business, and
Yeah,
they got a new CEO, and they've actually been in some trouble the last few years, declining, stagnant profits, et cetera, et cetera. And
yeah, because they suck.
yeah,
Yeah.
and but it's fascinating. You think about a company like Starbucks, which the entire genesis of it and its popularity became as like this third place concept of the neighborhood coffee shop.
Mm-hmm.
And it didn't take very long, to go beyond the founder of the company. And once it left that world, it became a drive-through sugary drink store,
Mm-hmm. Oh yeah,
like every other, chain in America. And it
yeah.
completely went
But
away from that original model because that power to be sucked into that system is so strong.
Yep, and that's exactly what's happened to them.
Yeah.
But but that's the system that is dominant. And if they wanted to add units, it's easier to add
Hmm.
units. You don't have to think as much in a situation like that. You
Yeah.
slap down a drive-through, exclusively drive-through, no third place whatsoever.
Yeah.
And a lot of America is built like that. And we're spending a lot of time in Fayetteville, in particular, working on what they call a 71B corridor, College Avenue, on a kind of massive scale sprawl repair kind of effort. And good for them. I love Fayetteville. I love what they're trying to do. Got a $25 million grant to try to unscrew up
Mm.
college. Meanwhile, I can name 10 corridors in Northwest Arkansas that like we're screwing up right now. Like, and
Hmm.
if doing it right the first time is so much easier than unscrewing it up. But man, we haven't learned that lesson
Yeah.
very well yet. But again, we're gonna have um, kind of more gridded system, a more diffused automobile system, which will be very functionally efficient, is not as efficient um, for commercial interests. It's
Yeah.
just not,
Yeah.
unfortunately.
So I want to get back to
For existing commercial
yeah, yeah,
interests,
yeah,
they got to change their business model.
right.
Yeah,
And I think there's a business model there that works. It's just it's going to
yeah,
be a different model.
absolutely. That's right.
So I want to get back a little bit to the aspect of like how you guys think about making money doing the projects you're doing. That I've heard you talk a little bit about this before, and especially thinking about different financing and investment models for town
Yeah,
center type projects versus other real estate investments. If you're thinking about sort of a develop and hold strategy, I mean, that sounds really cool. That also, to me, just or a novice that might say, boy, that takes a lot of capital and a lot of patience. Uh, and it seems to me like that's a model that takes 20 years to make money as opposed to things where you can make money in three to 5 years.
no doubt about it. It takes longer. Okay, I'm going to send you a graph right now. This has
All right.
been this verified what I thought I knew about investing in real estate, and this is the core of our thesis, Kevin. This articulates it better than anything I've ever done. So, 2 second overview of real estate finance, which is the easiest form of finance in the universe. The way real estate is valued is based on kind of what they call unlevered cash flow. So if I get rent of X minus operating expenses, that gives me net operating income. You divide that by the cost or the value of a piece of real estate, that gives you what's called a capitalization rate, cap rate. Cap rate is the metric by which real estate is values are set. Cap rate, since the biggest expense for real estate that's on a levered basis, so when you go and put debt on it, which is the way you own real estate, is the interest that you pay on that real estate. The cap rate at any given time, the biggest driver of that cap rate is not your operating expenses. It's really not even your revenue, surprisingly enough. It is that interest rate that's prevailing in the market. So as interest rates move, cap rates move. There may be a lag. The last couple of years, everybody's expecting interest rates to come back down. They haven't yet. Their cap rates are now been creeping up, but over time, interest rates drive capitalization rates, which means interest rates drive the value of real estate. The best measure, or kind of a good benchmark measure of interest rates, is the 10-year Treasury. That's the risk-free interest rate. A lot of things are a spread to the 10-year Treasury. What I've sent you is a graph that really hit home what I suspected. So if you wanted to invest it and you think that interest rates are going to go down, you can get in the futures market and you can make a bet that interest rates are going to go down in the futures market. And you can conversely, you make a bet that interest rates are going to go up. The futures market, which I believe in markets, I absolutely do, but they are the sum of the smartest people expecting interest rates in the future. And the graph that I sent around showed the actual 10-year Treasury, but also shows in pink on here the futures market expectations for interest rates in the future. And what this graph shows is the smartest people in the world did invest in interest rate futures, not guys that just build buildings. We are terrible. They are terrible at guessing what the interest rate is going to be 2 or 3 years in the future. Well, if I'm flipping a property, I start that thing now, or I start working on it now. 3 years is like blazing that I could get it designed, built, stabilized, and sold. That would be absolutely blazing. But I've got too many economics degrees, and I've learned that my crystal ball is awfully fuzzy about what's going to happen in the future. I used to, make a real meal out of like telling people what I thought was going to happen in the market. Now I realize I suck at that, so I don't even try. Well, turns out everybody sucks at that because no one can tell and if you can't tell what's going to happen with interest rates in 3 to 5 years, then your returns as a developer are completely a function of luck. So from 2010 to 2020, when you had kind of slightly declining interest rates, and even more so 2022, apartment developers in particular, they weren't particularly clever people. They all looked smart by slightly declining interest rates for over a decade. Mm-hmm. They weren't smart. They just happened to catch a great run, and that's what happened. But they're getting their teeth kicked in right now because since 2022 we've had much higher interest rates, and now we got a president that doesn't seem to be too concerned about tariffs potentially driving up interest rates further, or at least muting their ability to go down. And we got a lot of headwinds that seem to be keeping interest rates high. But again, I don't know. They may be really low in the next 2 or 3 years. Once I just realized that I don't control nor can I predict the primary component of value of real estate in the short term, it was very liberating for me because it actually kind of lined up with my philosophies about holding real estate longer term. If I can't predict what's going to be the price in 3 to 5 years, but I can tell that Northwest Arkansas is growing, and the bigger picture fundamentals are actually easy to predict, I can actually make investments that perform well over time. It's just I don't know when I can harvest that investment. But if I want to maximize a value, for instance, 2022 had exceptionally low interest rates and stupendous valuations for real estate. If I can't make that happen, and I don't know when that's going to happen, but I want to be available to take advantage of it when it happens, I can't build something that's crummy that won't hold up very well. That's Class A for a very short moment in time. But if I build something that's durable, so it has to physically hold up, and enduringly attractive, and that means from beautiful design to fantastic location, then when 2022 rolls around again, I can take advantage of it. So that's the overview of our investment thesis. We can't predict the prices in 3 to 5 years, so we don't try. But we build stuff that holds up value exceptionally well, so that when a good selling opportunity rolls along, we're ready to take advantage of it.
So if I were to paraphrase, it's more like a way to have real estate be a great income stream and a job and an income stream, but not a get rich quick scheme, right? Yeah,
That's
you
right.
could get
Yeah,
rich.
yeah, yeah.
You could make good
No,
money if with some good timing down the line, but it's not like you're going to all of a sudden go from zero to making $500,000 a year.
yeah, that's right. That's right. And those guys that kind of do kind of crack the ball out of the park. There's the smart ones that kind of use that to retrench, and then there's the ones that strut around like a peacock and then get just double down. And then when things aren't rosy, and they can operationally be improving. They can be better at operations than they were before, but they catch a bad timeline.
Yeah.
Then they can make very little money for
Yeah.
a couple of years.
So
So
do
with
you,
the same amount of work.
yeah, do you have a different kind of investor potentially then that invests in your projects versus other assets?
Yeah, so that's incredibly important. So you have to have investors that also share that longer term philosophy. So there are in the investment world, there are kind of two primary forms of what we call a private investor. One is private equity firms. Private equity firms, for very good reason, they have a timeline they put together a fund, and they'll have a timeline for everybody that puts money in their fund to get all of their money back. Because for the vast majority of us, we just can't leave money in the fund forever, and we need to know when we're going to get our money back.
Mm-hmm.
So a lot of times they'll have a 10-year fund, but all their investments will have a 5-year kind of maximum hold period for any given investment. Well, that means if you catch a if you had a property delivering in 2023 and you're running into your timeline, you got to sell it according to the requirements of the fund that you invested in. So they're having to make non-rational decisions about when to liquidate properties that hurt their investors, but it allows investors to get their money back. We don't even try to work with private equity funds. There's a lot of other reasons as well. Because their timeline is so short, they have all the incentive in the world to save a penny. For instance, if a property, they think a property is going to sell for a 6% cap rate. We talked about cap rate, and you can save $1 of construction. You divide that by 6%. $1 in savings in construction is a $16.67 saving or increase in their profit. So they build as crummy of a property as they can get away with and squint and say that it's adequate to try to flip into the market. And that's what we see built everywhere. And all that crap that I saw in Denver, that's that crap. It's just really made with spit and baling wire and bubble gum, and it does not hold up. It doesn't hold up very well. And they dominate the market. They're far and away out of the much larger market share. The other types of investor, and the ones we kind of target is, and you hear a lot about these now, are family offices. And this is families that have accumulated wealth. They've usually built a company and sold a company, and they're trying to figure out how to make money going forward by investing. Which God love them. These folks have a lot more flexibility with how they handle their cash, and they'll also have a bifurcated, portfolio where they may have, a portion that's set aside for longer term stuff, like what we're doing in Johnson or Drake Farms, that really can do really well over time. And they also realize that when they make an investment into a private equity fund, or a private equity fund makes an investment, or they make an investment, when they sell out of that investment, and what doesn't show up in return statistics is it's risky, and you lose time value of money between investments. So reinvestment risk does not show up in a lot of valuation, or a lot of performance metrics. Well, those guys understand that. They understand that really well, because they've gotten their money back before. And what the hell am I going to do with this now? So it was hard to get it in something. About the time I started to really like it, man, they flip me out of it, and now I don't have that money. Um, so a lot of times, family offices or wealthy individuals, they will have more flexibility on their investments. They also, especially if they're local, they are more likely to want to invest in something they're going to be proud of.
Yeah.
So we our goal is to make them look smarter than all of their friends at the country club by having their investments perform better than their investments in other projects, and to have something that they're proud of, saying they're a part of when they take their friends out to dinner. So
Yeah.
it's so we end up the way we cobble it together. We usually get smaller checks from individuals. We're really kind of improving how we do this over time. And the other thing we do is that we is when we the way we make our investment was we'll buy a piece of cash, a piece of land in cash, so we don't ever have debt on the land until we're ready to develop it. Then we'll borrow against the land. We'll roll fully developed pads into commercial projects, and this is kind of an esoteric point, but the vast majority of construction risk is below ground stuff. So site development. We've taken that on. My partner's background is construction, and he's fantastic at managing that risk and executing on that front. So by the time our investors come in, we're in the low risk portion, and we get a pop of value for that. So we get to capture a lot of a decent chunk there, and then we just let our investment roll forward. So that's how we put deals together.
Interesting.
It's very, very simple. We've got and then the other thing we've kind of earned our way towards, Kevin, and this happens earlier in your career than you might think. That people will start coming to you with pieces of property and say, "Hey, what does it take for you to work with me on this piece of property? I want to be a part of something cool." Usually that's kind of their thing, and we're like, "Okay, we've got a." I'm slightly proprietary about it, but the way we work with land partners is they put in a piece of land and we put in the time, how that financially works for them to do exceptionally well on the land side, and then roll it into the vertical piece, so that they're very well rewarded for that. But it happens often enough. We're incredibly picky about what pieces of the property. The key for us is we've got to have 100% control, and that some landowners that's a non-starter. Well, it's a non-starter for me too, so I'm not doing it anymore. So I've done it the other way, and I've never had a land partner that had any degree of control that was anything other than a boat anchor on us getting developed.
Yeah.
Wonderful people, love them to death, made money together, but I'm not doing it like that anymore.
Yeah.
Because I don't have to.
Is there this kind of a random thought? Is there a way to crowd fund longer term investment like that, where it's you get a whole bunch of people who say, "Well, I want to put $5,000 into this because that's what I've got."
Yeah. I mean, I guess it can happen. The everything we do has got accredited investors, so they got to put in a big chunk of money. The accredited investor thing is kind of it's got its positives and negatives, but the minimum net worth required to be an accredited investor is a hurdle. Plus, we find that a smaller group of investors is easier to manage. We'll let friends and family in for less, but we got a project we're financing right now, and we're kind of, it's got to be $500,000 checks. We're letting some people that have kind of $250,000 checks, kind of get in a sub LLC themselves with somebody kind of taking charge from, a couple of friends or something, and they may put in $1 million, but it's 4 docs, but $250,000, something like that. But it's just, that's from a management standpoint. If we're raising $15 million in equity, I just don't, just can't. Yeah, can't be fooled with somebody's got $5,000.
Right.
It's just, I love the egalitarian idea of crowdfunding, but I got a business to run. So
yeah, no doubt. Would you work outside your region, or does this model only really make sense if you're focused just in your region?
The model would work outside the region. I'm just too lazy to go anywhere.
Yeah.
Like Springfield, Missouri is down the road, and Tulsa, Oklahoma is right down the road. Downtown Tulsa is coming on staggeringly. But I just, there's more that I can do in Northwest Arkansas that I really like than I can do myself.
Yeah.
So.
Yeah. So let's talk small development, incremental development a little bit. So
Yeah.
we were going back and forth a little bit, and you said you've kind of come full circle thinking about this advice about getting people into incremental development. What's what's going on with that?
Well, I mean, I'll take the positive side first. I've been enthusiastic about kind of incremental development, and I've got a lot of friends that are super bright that kind of work in that
Hmm.
realm and really put a lot of effort into that realm. Um, and at its best, it is again it's that egalitarian thing. It should not be so damn hard for somebody to develop a piece of real estate in the United States of America. If somebody has a business and they want to own a store, they ought to be able to build a store pretty easily and not have to have a massively specialized store of info. I could come up with a better analogy. Massively specialized amount of information in their head about how to get that business, that premises for that business built. But that's not the way it works anymore. In fact, I'm a beneficiary of the inefficiency of the system. I love building medical buildings and docks that if they've ever built something before, they're cured of trying to do that again. So we work with them on buildings. Um, but it's because it's incredibly difficult. There's not a business in the country that looks easier from the outside and is more difficult on the inside. In fact, I've had plenty of people ask me, "What do you do on a kind of daily basis?"
Mm.
And honestly, that's a good question. The role of developer maybe should be less central in how stuff gets built. There's too many middlemen. Maybe there should be less of me. But the but that's the system we live in. So my critiques of incremental development aren't from a philosophical standpoint. I actually really like the philosophy, and I really love the
Hmm.
hacks, pattern zones, and stuff like that are
Yeah.
hacks on the system to make it easier to do incremental development. Um, but you have to become a hack expert if you're going to be doing it, which means you're not an expert in all the other areas that you need to be an expert in to build something, which is what's the fundamental demand. Like that should be the driver of whether somebody can do that is if they can identify where something would work. That's not the case. You got to be an expert in the hacks. And then just functionally, we tried recently. We kind of, it's not exactly patterns of. We started with a chassis of a building we call a sugar cube,
Hmm.
working with Rob Sharp on a very simple 12 unit kind of box that fits on a lot of downtown lots and adds general density, and it's beautiful and easy to reskin. It's just
Hmm.
it's good looking around. We love to invest in downtowns. It's hard to do big projects. I really don't like most big projects in downtown. Let's see if we can sprinkle as part of our business. Let's sprinkle one a quarter, everywhere.
Yeah.
We're in wrapping up construction on our first one right now, and it took us. I say 16 months, but I'm almost positive I'm short from when we applied for a permit initially in Springdale, Arkansas, and just with incredible staff support and a kind of a bastardized form-based code and to test their version of a form-based code in Springdale, um, but it took forever to get through the regulatory process,
Hmm.
and absolutely has cured me. I mean, if it wasn't just me and my partner doing it, and we had investors, or if we had if I was relying on that to get a fee to feed my family or anything like that, it would have been a catastrophe. And we could absorb it, but none of this, we're rolling one of these things out once a quarter predictably, and because they're very bite sized, and we got our construction figured out. We can't do it. So I struggle with um, you know with doing that. If there was a pattern zone and this was approved in the pattern zone and it covered enough of a city and the decision making was really at the staff level, you could entice me back to the idea again, but
Hmm.
not right now. You know.
Yeah.
So so my complaints about it are just a absolute recognition that even in places that are really excited about incremental development, it's it's a bear.
Yeah. So
Yeah.
the regulatory side. What about the actual development construction side?
Development construction side is, that's another thing. Oh, it's more expensive per foot, more expensive per unit than anything else we're working on.
Hmm.
It just doesn't, so uh, it's not like it was a streamer. It's not like, oh my God, well, I was going to make so much more money with this. It's a 3-story walk-up building, but it's just expensive. It's an expensive building to build. So,
Yeah.
relative to other stuff that we do, so it on it. If we were just rolling these things out, it's not like they would be getting these outsized returns that or something like that. And then there's kind of other more subtle pieces. Like I was, trading LinkedIn notes with a guy that was working on it was a designer working on a cottage court in Bentonville. But there's certain types in the incremental development world and this is again very subtle, but a cottage court is the highest and best use in a very narrow range of lot values.
Mm-hmm.
Like lot values above a certain amount, and they're not efficient enough. Lot values below a certain amount, you just need to build a house. That's the easiest thing to do, roll them down the road. In this very narrow range, they can be effective, but they also need to be physically, the lots or the aggregation of lots need to physically really well accommodate a cottage court. And you see a lot of really kind of tortured cottage courts where the public shared spaces are inferior. Well, if a cottage court, you're trading private space for better public space, and if that trade-off isn't being achieved, you're not going to do very well with your cottage court. Then you got all sorts of issues with appraisals and that sort of stuff. But that to me, I love cottage courts and I love them as a component in a town center project where I control all the variables and stuff like that. But they are hard to do in most practical applications. So you end up with stuff like that.
Yeah.
Big fan of ADUs. There's not an investment in the world of real estate that's, if you're already going to build a garage,
Yeah.
there's nothing that has a greater return than just adding an apartment above.
Yeah.
There's
Yeah.
nothing that I do on a daily basis that touches it. So everybody in the world ought to build an ADU if they don't already have a garage. If they think they want a garage, build an ADU.
Yeah.
It's the most flexible space you have if you never rent it out. If you don't rent it out and you've got a family, the kids love having that a little more, being a little bit separated from the house. You feel a little more grown up. And then when they, go off to school and they come back, when they come home at night, they're not waking you up. And then when they come back with kids, they can be, you can have them in the house all day, but you can send them away at night. And then, it's fail. So we're SEC town, when the kids are out of town, you can rent it out for a couple of football games a year and make pretty good income on, 10 nights a year, graduation, so that sort of thing. And it's just very flexible, very useful, and high return space. And if you just rent it as apartments, it's less per unit than I can build apartments for and considered superior by renters.
Yeah.
So, ADUs, I think, are a real screamer in the incremental development world.
So, I mean, I guess it begs the question: how does uh, in your mind, how do we get to a place where doing some of those incremental projects, the sixplex, the 12plex, the small mixed use building on an isolated parcel, how do those get viable?
Um, Either we have to have a different regulatory process that doesn't reward scale, you know, um, uh, that makes smaller stuff more worthwhile, makes larger stuff relatively more difficult, smaller stuff relatively easier. So a parallel process, recognizing that, if somebody does something wrong on a fourplex, it's not nearly as catastrophic as if somebody does something wrong on a, 120 unit building. Just that recognition alone and change the regulatory process. That's the best thing to do. The kind of facsimile of that and recognizing that that's less likely to happen, that code rewrites are a massive lift for cities and they usually screw them up when they do them anyway. So then the pattern zone thing, especially a lot of my friends, Matt Hoffman and Matt Petty, kind of really kicked off the pattern
Mm-hmm.
zone things. A couple of folks have followed along that are doing it, with varying degrees of competence. But the pattern zones have real legs. But to me, um, they're most effective when they're most broad and when they reach up into building size. You can get to 12 plex, that's fantastic. And the key is with the if the project is within the bumpers, then the staff can approve it.
Yeah.
You don't have to tie it up with the neighbors.
Right.
When the city council gets incredibly unpredictable, if it's zoned for it, and it meets the goal and intent, staff needs to be able to approve this project. That's how I think you can really encourage incremental development, and I like it because there's right now with development, it's hard to be a small developer. It's hard to learn development. There aren't Our company develops a lot of real estate. Our development side of our business is 4 individuals, and I'm one of them. I mean, it's me and my partner, director of construction and director of pre-construction.
Hmm.
Maybe we need one more, but you know, but if we're hiring somebody, we're not going to be hiring somebody green out of college. I'm not going to be sitting someone on my knee and teaching them how to develop real estate. I don't have time, and I'd like to do it. I just don't have the need for it, and I don't. It's hard to do, and on a fee basis, we just don't make much money on a yearly basis. Our value is owning real estate. So it's hard to get knowledge in real estate. There's not many jobs as a developer, and so the natural laboratory would be go out, do something small, screw it up, and then learn and do something better next time. And that's where it's difficult. And it's kind of a shame.
Yeah.
I love that so many people are working on it. I don't want to discourage people from working on it. I just think it's a hard road to hoe.
Yeah.
And it's not as easy to do as like on the side. It just takes so much time. It's just a hard. It's just a tough thing.
Yeah. I mean, it feels like there's like a scale of something you could probably handle on the side if you're
Yeah,
young and you've got energy or whatever. If you're in a place in your life where you've got the time and energy, you've got a full-time job that's manageable that you can keep within certain boundaries.
yeah.
Then you could do something small. You can do a duplex or a fourplex or maybe a small commercial renovation or something. But
Well, what really kind of prompted me on this front to kind of start that initiative that we've abandoned is that if we would have developed a fourplex, if I'd have developed one fourplex a year when I was 20 years old, I'd have more net worth now than all the big projects I've done because I've done I had to do big projects for other people to then be able to get the access to capital to be able to do them for myself. And so just now am I able to kind of really kind of drive what I get on as far as ownership. Well, if I could have just done one fourplex a year and had a real job on the side, I'd have probably done as well or better.
mm-hmm.
But then it's the regulatory lift,
Right.
is heavy, and the knowledge base required to even do something as simple as that is very hard. I'll hear a lot of the ink dev folks, say, "Oh, it's simple," and then they'll go through a, 45-minute or 2 days worth of presentations where it's just a absolute fire hose of information going to people of how it's not simple.
Yeah. Yeah. No doubt. No doubt.
Yeah.
And even then, honestly, the one fourplex a year sounds really great, for a little bit, but
Yeah.
there comes a point where it gets overwhelming, and you still have to manage it. If
Yeah.
you own it, you got to manage
Still got
it.
to manage it if you own it and all that kind of stuff. But if I'd have started when I was 20 years old and put them on 30-year mortgages, my first 3 years worth would be paid for right now in cash. Just and not to mention that the cost basis 30 years ago would have been $75,000 a unit or something.
Yeah.
If you built them durably, I mean, by now you'd have replaced all the HVAC and all that kind of stuff, but it goes back to durability.
Mm-hmm.
So if somebody were to take this approach, they will think about it more long term. They'll naturally think about it more long term.
Yeah.
You find people since they can't do it with like a fourplex, they'll do it with houses. They'll buy or build a house a year. Every time they get a little bit of cash, they'll buy or build a house. But a house it's depending on where it is, it's a break even or negative cash flow situation. Well, that's a slug over time, you know.
Hmm.
What happens, what I usually see is people, they'll build a little portfolio of houses and they'll sell it. They'll
Hmm.
get sick of it and they'll sell them all. They'll get tired of fooling with it.
Yeah. Yeah. Or they're flipping houses. So,
Yeah. Which is, looks easier on TV than it is in reality.
no doubt.
Yeah.
Uh, Ward, if anybody wants to track you down and talk to you further, what do you suggest? What's the best way to find you?
Yeah, the best way to get me is to send me an email, ward@highstreetred.com. Just send me a note if you listen to this and you kind of want me to follow through on any of the stuff we talked about. I've got, you know, I enjoy talking about it.
And you
Spent
reference,
a lot of time thinking about it
yeah, no doubt, for a lot of years.
for a lot of years.
And you referenced CNU recently, and you've got that coming up next year in Northwest Arkansas.
Yeah, that's the big. It's kind of a pitch. Is that I'm co-chair of the local host committee for the Congress for the New
Hmm.
Urbanism next year. I'm excited about that. Again, we are a region that has great growth statistics, and has a lot of new urbanists. So we have the brains that could grow better, and we also have foundational support, namely the Walton family, that have invested heavily in urbanism and in people's knowledge of urbanism. Ironically, to some, but I
Hmm.
don't care. I like that they put their money where their mouth is, and they really would like to see the world grow differently, and they're very genuine about that. But we've got the foundational support, we got the knowledge in the region, we got the right kind of growth, and we've got a real shot at it. But if we can't figure out how to grow better than other places, then I'm discouraged that anybody else will be able to do it, because we've got the right mix here, and we're working like hell. And as part of that is getting Congress for the New Urbanism here for us to learn from, and also to show off cool stuff in Northwest Arkansas.
Yeah.
Northwest Arkansas is a surprisingly interesting place.
Yeah.
So
Also happens to be a
yeah,
very beautiful natural environment.
yeah, naturally beautiful and gorgeous.
And if you're a mountain
Gorgeous
biker,
environment.
then it's a little bit of
Mountain
paradise.
biking capital of the world, which sounded ridiculous when they first said it, but it turns out that they made it happen.
Yeah, no doubt.
Yeah,
All
yeah,
right.
no, no doubt.
Well, Ward, thanks so much for doing this. I really appreciate the time. I know you got a lot you're managing, so I think this is really helpful for a lot of people. So,
Thanks so much, Kevin.
you
I
bet.
enjoyed it. It's good to catch up anyway.
All right.
Talk to you soon, man.
All
We'll
right.
see you, bud.
See ya.